Hello, everyone. Welcome to our Chapter 5 lecture covering merchandising operations and the multiple step income statement. We'll focus on inventory, merchandise inventory, and we'll look at what's known as the perpetual inventory system and how to record our inventory transactions under what's known as the perpetual inventory system. We'll then look at and learn how to prepare what's known as a multiple step, sometimes referred to as a classified income statement, and a comprehensive income statement. We'll learn how to calculate cost of goods sold under what's known as a periodic inventory system. And lastly, we're going to learn how to calculate and analyze what's known as a gross profit rate and a profit margin. So these are our objectives we're going to cover here in Chapter 5. So you ready? Let's go. First, we look at different types of merchandising companies. These are companies that buy and sell goods. So whether we're talking about Walmart, Amazon, Office Depot, examples of different type of merchandising companies. So you have these wholesalers who often will make the actual product that are then sold to the retailer, such as an Office Depot, and they're then acquired by you, the consumer. Okay? So from a business perspective, when the retailer, Office Depot, or the wholesaler sells the product, they're going to record it as sales revenue or sales. Now, hope you can see this okay. I tried to make it larger, but not make it where it wasn't visible. This is a balance sheet for Walmart, okay? And these numbers are in millions. And I want to focus on the inventory amount for Walmart. Notice that number is 44,269. Because these numbers are in millions, that means that for Walmart, their total inventory total roughly $44.2 billion. I'll say it again, $44.2 billion worth of inventory. That's why we have an entire chapter dedicated to learning how to properly record our different types of inventory transactions. Now, for a merchandising company, this is the typical structure of income measurement. All right. Sales revenue is the actual sales price of an item. Cost of goods sold is the amount the company paid for the item that was sold to you, the consumer. If you take your sales revenue minus your cost of goods sold, it shows the gross profit, which is really just a markup of the product that was sold. If they paid for a product, say $60, but they sold it for $100, then the gross profit would equal 40%, or the gross profit would be $40. So gross profit is sales revenue less your cost of goods sold. Now, for any company, they will also have what's known as operating expenses, cost of doing business. They have to pay their employees, they have to have supplies, pay rent, insurance. Those are known as operating expenses. We subtract those expenses from their gross profit to determine their net income or their net loss for that particular accounting period. Operating cycles. If you are a service-based business, notice that you're not really in the business of selling products, you're performing actual service. So for a service-based business, you begin with performing a service, such as providing automotive services. Sometimes the service is provided on account, meaning that the client hasn't paid us, so we have account receivable. The client will then mail us a check, and we're going to receive the actual cash. Now, for a merchandising company, we have to first buy the inventory, such as these nice TVs. Then we have to sell the inventory. If they're sold on account, we're going to recognize account receivable. Then when the payment comes in, it's going to increase our cash. So these are the typical operating cycles for a service-based business and for a merchandising company. Our main focus today would be on the structure for a merchandising company. Flow of costs. Again, we're looking at the acquisition or acquiring of inventory. So you begin with your beginning inventory. That's what you had available at the beginning of the accounting period. You're going to add to that your cost of goods purchase. That shows what we acquired during the current accounting period. When you add those two amounts together, we call that the cost of goods available for sale. Simple illustration. If we begin with 2 TVs at the beginning of the period, then we purchase 5 more TVs, add those together, we have 7 TVs now in inventory. The cost of those 7 TVs will be what's known as our cost of goods available for sale. Now, think about inventory. And we're saying, what do we do with inventory? Well, there's only 2 choices when it comes to inventory. Either we've sold it and recognize your cost of goods sold, or we still have it remaining and it's part of our ending inventory. So again, simple illustration. If we had 7 TVs and we sold 6 of them, we only have 1 remaining as part of our ending inventory. Now, I'm giving you an illustration based upon quantity, but we'll also look at the cost of those items to determine the value of our cost of goods sold and the value of our ending inventory. There are 2 different types of inventory systems. What's known as the perpetual inventory system and a periodic inventory system. Most corporations now use the perpetual inventory system, so that would be our main focus, how to record inventory using a perpetual inventory system. Now, with a perpetual inventory system, we're going to maintain detailed records for each purchase and sale of inventory. So think about your last visit to a retailer, whether it's a grocery store, clothing store, etc. When you purchase those items, they're going to scan those items. What they're doing is they're doing a detailed record of what was sold for that particular accounting period. The same is true when they purchase items as a retailer. They're going to scan those items and put them into the inventory system. With a perpetual inventory system, we have a continuous show of inventory that should be on hand for every item, meaning that the computer will tell us how many we should have of each item left in inventory. We use that information to determine our cost of goods sold for the sale of each item. So the perpetual is a continuous type of inventory system. Every time we buy or sell inventory, we're going to update our inventory records. With the periodic inventory system, again, which is not as popular in 2020, with the periodic inventory system, we determine our cost of goods sold at the end of the accounting period. Now, this may be done at the end of every week, every 2 weeks, and the end of each month. When we look at our beginning inventory, we'll then add in the purchases, and you add those together to show what's available for sale. We do a physical count to see what's remaining. That's your ending inventory. And then the difference is known as your cost of goods sold. So with the periodic inventory system, we don't compute cost of goods sold until the end of each accounting period. Now, this method is probably only used by smaller companies that may not have the technology to keep track of inventory. They don't maybe not have the scanners and things of that nature. But again, we'll take a look at the periodic, but our main focus will be on what's known as the perpetual inventory system. Okay? So with the perpetual inventory system, again, this used were traditionally with high unit value. So when items cost more money, we want to make sure that we're keeping track of it. With the perpetual system, it shows the quantity and cost of inventory at any given time. So we can go to our computer and see how many we have of each item that we're selling with the perpetual inventory system. Also, there's better control over the periodic, because with the periodic inventory system, we make the assumption that if an item is not there, that it was sold. But was it? Was it really sold? Because sometimes inventory seems to grow legs and walk out of places. Keep that in mind. So we're going to go through a few transactions with the perpetual inventory system. Here we have an invoice, PW Auto Supply. They sold supplies to Sauk Studio, or Sauk Stereo, I'm sorry, not Studio. And they gave them terms, 2/10, N/30. Remember that, 2/10, N/30. We'll discuss those terms a little bit later. And also, there's something called shipping terms that says FOB shipping point. FOB shipping point. We'll discuss what that means as well. So notice that the total for these products total $3,800. So we're going to record this transaction using the perpetual inventory system. So to record this transaction, assuming that we are Sauk Stereo, we're the buyer. Okay, so this is the journal entry made by the buyer, which is Sauk Stereo. You would debit inventory for $3,800, credit accounts payable for the same. Again, this is journal entry made by the buyer. You would debit the inventory account for $3,800, credit accounts payable. By the way, what type of an account is inventory? If you said it's an asset, you are correct. To be more specific, inventory is known as a current asset account to be shown on the balance sheet. Okay? Next, we have what's known as freight costs. You see, we have FOB shipping point, and we have FOB destination. Perhaps you're saying, what does FOB mean? I'm glad you asked that question. Stay tuned. We'll give the answer in the next section of our Chapter 5 video lecture. Bye-bye.